Elon Musk and the Twitter insider trading allegations, a deep dive into ethics and market impact. Elon Musk, the CEO of Tesla and SpaceX, is no stranger to controversy, and his recent legal troubles related to his acquisition of Twitter shares have further highlighted the complexities of insider trading and corporate governance. In this analysis, we will explore the events surrounding Musk's actions, the implications of acquiring shares at purportedly artificially low prices, and the potential consequences for Musk and the broader market. The lawsuit against Musk centers on allegations that he purchased Twitter shares at prices lower than their market value, taking advantage of non-public information relating to significant developments at the company. Critics allege that Musk's actions amount to insider trading, taking advantage of his position and access to confidential information to secure significant personal financial gains. In the world of corporate governance, the ethical implications of leveraging such information are profound. Investors depend on trust and transparency to make informed decisions. Violations of these fundamental principles can ripple through markets, eroding public confidence in the fairness of the system. Insider trading occurs when individuals buy or sell stocks based on material information that is not yet available to the general public. Such practices undermine the principle of equality for investors, creating an uneven playing field where only a select few reap the financial benefits. To mitigate this unethical behavior, regulatory bodies like the Securities and Exchange Commission, SEC, in the United States actively monitor stock trades. In cases of malpractice, the SEC can impose fines, revoke trading licenses, or even pursue criminal charges. Analyzing Musk's case raises questions about how effectively these regulations prevent abuses of power by influential executives with privileged access to information. The illegal nature of insider trading stems from its inherent unfairness. Imagine an investor purchasing shares based on optimism for a company, unaware that a corporate leader is secretly manipulating the timeline of major announcements to their personal advantage. When such gaps in information exist, the protective mechanisms of the stock market begin to falter. Musk's relationship with Twitter has been both controversial and influential. His growing interest in the platform culminated in a significant acquisition of equity shares, making him one of the company's largest shareholders. However, allegations suggest that he may have used insider knowledge to time these purchases, benefiting from future developments that the public was unaware of. Detractors claim that Musk had access to privileged data about Twitter's future prospects, such as user growth metrics, financial outlooks, and strategic plans. By purchasing shares before these positive developments were publicized, Musk potentially positioned himself for massive financial gains once the stock's value appreciated. This has triggered debates among legal experts, consumer protection advocates, and market participants about the extent of Musk's responsibility in the matter. Timing is critical in the case against Musk, as critics point to the alignment of his stock acquisitions with sensitive operational moments at Twitter. Allegedly, Musk's buying spree occurred just before the company revealed positive shifts in its business strategy and operational performance. Such perfect timing raises questions about whether Musk acted as a prescient investor or benefited from information that a typical shareholder would not have access to. If regulators prove that Musk leveraged insider information, the implications extend beyond regulatory penalties. Such findings would set a precedent for high-profile executives who may walk a fine line between aggressive investing and unethical trading. For Musk personally, the consequences could spell significant legal, financial, and reputational damage. The potential fallout from Musk's alleged actions also extends to Twitter's regular shareholders. Smaller investors often operate without the resources or insider insights that major stakeholders can access. If figures like Musk are found manipulating stock trajectories, It undermines the trust of everyday investors and shakes confidence in financial markets as a whole. Market volatility is another critical issue. Allegations of insider trading in tech stocks, which are already prone to sharp fluctuations, could exacerbate public wariness toward the sector. Concerns about corporate accountability might make investors hesitate before supporting other fast-growing tech enterprises. Should the court find Musk guilty of insider trading, he could face a range of legal penalties. These might include significant fines, mandates to compensate affected shareholders, and restrictions on future stock trading. Beyond financial consequences, such a ruling could limit Musk's ability to maintain leadership positions in public companies due to the increased scrutiny and loss of credibility. Musk's reputation has always been a double-edged sword. On one side, he is revered as an innovative disruptor. On the other, he's regarded as a polarizing and unpredictable figure. This lawsuit could tip the scales toward the latter in the eyes of investors, business leaders, and regulators alike. Furthermore, Musk's other ventures, such as Tesla and SpaceX, may feel the ripple effects if public opinion or shareholder trust diminishes as the case unfolds. Musk's legal defense is likely to challenge these allegations vehemently. His lawyers may argue that his trading decisions were based on publicly available information and basic investment strategies rather than any insider advantage. They might further emphasize that Musk's stake in Twitter was a natural extension of his expressed interest in social platforms and not an opportunistic tactic to exploit non-public knowledge. The counter-narrative could also highlight Musk's reputation for innovation, framing the accusations as an attempt to stifle an ambitious entrepreneur who has always sought to push boundaries. This defense, though persuasive to some, will hinge heavily on whether the evidence definitively establishes a connection between Musk's actions and insider information. This case is not just about Musk. It calls into focus systemic issues within corporate governance and market regulations. High-profile lawsuits like this one illuminate weaknesses in enforcement systems and question whether current laws are sufficient to prevent unethical trading practices by top executives. Stricter regulations could emerge in response to this controversy, such as mandating more rigorous disclosures of executive stock purchases or implementing tighter restrictions on access to sensitive information. A key outcome of this debate could involve finding a balance between fostering innovation and ensuring accountability, especially for leaders whose decisions impact millions of shareholders. Public sentiment often shapes the trajectory of matters involving prominent figures, and Musk's case is no exception. With millions of followers and a dedicated fan base, Musk's decisions are under constant scrutiny. Media coverage of the lawsuit not only affects Musk's personal brand, but may also sway investor behavior toward Tesla, SpaceX, and other ventures he spearheads. Public trust in corporate leadership is a fragile commodity, one that Musk risks undermining. While some may continue to view Musk as a visionary disruptor, others may lose confidence in his management style if the allegations gain traction. This shift could resonate through markets, influencing share prices and investor loyalty across Musk's portfolio of companies. Elon Musk's alleged purchase of Twitter shares at artificially low prices raises critical concerns surrounding insider trading and corporate ethics. The outcome of this case could serve as a watershed moment, reshaping how regulators approach executive accountability and disclosure requirements. Furthermore, it highlights the complexity of overseeing corporate governance in an era defined by rapid innovation and concentrated power in the hands of visionary entrepreneurs. As the legal proceedings evolve, the case will prompt closer examination of the fine line between aggressive investing and unethical conduct. Observers from industries spanning tech, finance, and law will watch closely, recognizing the potential implications for investor confidence, regulatory standards, and market stability. In conclusion, Musk's case underscores the importance of fairness and transparency in market practices. As public attention surrounds this high-profile lawsuit, it's clear that the repercussions will extend far beyond one individual, influencing corporate and legal landscapes for years to come. Ultimately, the resolution may serve as a reminder of the significance of fairness and integrity in sustaining a robust and equitable financial ecosystem.